Welcome to Mad Money. Welcome to Cramer America. I'll be with my friends. Hey, I'm just trying to make a little bit of money here. My job is not just to entertain, but to put it in context. Call me 1-800-743-CBC. Tweet me at Jim Cramer. On the surface, the stock market seems totally binary, dancing to the tune of a president who likes to take the average into his own hands and raise or lower them depending upon the circumstance. When the market's up, outsiders say, hey, things must be good. When the market's down, they figure things are terrible.
A house of pain.
Now, that may be true if you own just nothing but index funds. That's fine. I own index funds. Today was another good day for index fund holders. Dow gaining 307 points, S&P advancing 0.55%, NASDAQ climbing 0.91%. But what if you're doing what I advise and how to make money in any market? What if you actually are marrying your index funds, like I do, with individual stocks? Because you want to own some high-quality companies in order to rack up outsized gains. Consider, for me, I've got my index funds, and then I've got my travel trust. Now, most of you had a chance to own long-term winners like Apple or Amazon or Nvidia if you have been even part-time watchers of this 20-year-old show that's been deeply committed to owning these stocks. We created FANG, Facebook, Amazon, Netflix, and Google 13 years ago to get you to buy those stocks. We added Apple to the mix not that long after because we wanted you to own those stocks. It's reasonable to believe that you would have bought some of these household names, even as many professionals advise you to steer clear of stock picking because they think you're too dumb. I disagree with that. As long as you're disciplined and do the homework, I'm confident you have the ability to trounce the S&P 500 with your individual stock portfolio. It's just true. What happens, though, when the great ones, the ones that have worked out so well, what happens when they start running out of gas? What happens when they're running on fumes? What happens when they lose their leadership qualities and get confined to the dustbin of stock history? First, as I said today, and what my wife says was kind of a somber investing club meeting, I didn't mean that. I don't believe that any of the mega cap tech stocks are truly finished, including the Magnificent Seven, but also semiconductor colossus that is Broadcom, which acts really badly. I don't talk about this much on Mad Money, but I think I should. I'm always looking to see if a company's getting its due for how much it earns. Its due is also considered to be the multiple, or more clearly, the price-to-earnings multiple. If a company's liked in the marketplace, the stock will reflect that by having a higher price-to-earnings multiple than stocks that are disliked. But if a company goes out of stock, if people stop believing in it, then the market places a lower price-to-earnings multiple on the stock. Think of it as a shorthand way to look at how a company's faring, and it's mystifying to many. So I want to bust that. Let's explain what's going on with the weakness so you understand what's happening with these iconic stocks that everyone used to talk about all the time. It should be obvious right now that the Magnificent Seven and their buddies bereft of friends in this market. Take Meta. People were paying 30 times earnings high, for the stock as recently as a year ago. Now they're paying just 22 times earnings. Whoa. That's a sign the market's gotten skeptical of Mark Zuckerberg and the company's growth rate, which is the most important quality to factor in when you're deciding what to pay for stock. It's a sign that Meta has lost its way. There, I said it. Meta's lost its way. Jumped today, but Meta's revaluation, let's call it that, is severe. But the price-to-earnings ratios of the Mag 7 have been shrinking pretty much across the board, causing lots of people to worry that the bloom is off the rose and they have to make adjustments. I would contend that that's not true. I know that something else could really be at work here, and I figured it out. The Seven are known for their consistent high earnings power. Right now, as I said earlier this week, you have real concerns about the earnings power because there's this private company, OpenAI, that's spending fortunes, and that's doing it to take share and hurt all these companies. At the same time, OpenAI does business with a bunch of companies, and people are now questioning whether it'll be able to pay its bills. I think OpenAI is like the open sore. It can really hurt a lot of things. I call it the Achilles heel. But there's another force that I'm not talking about. This you got to focus on, people. This is something I haven't talked about to you. It's a huge part of the story. There's a new group of tech stocks in town, and they are sucking up money from the rest of the sector, from the Seven. And these are prosaic, boring companies. They're storage plays. I have been talking about the storage plays as a warning sign because they've rallied so far so fast. But there are tons of investors who love to chase hot stocks. And if they want to buy a Sandus or a Seagate or a Western Digital or a Micron, wow, the best place in storage, they got to sell something. They don't have the money sitting around. They got to sell something to be able to buy them. And you know what they're selling? They're selling the Seven. Consider Micron, very good semiconductor company. You know, we talk about them all the time. Makes storage components. Stock's up 39% since the beginning of January. Seagate, 26%. Crazy SanDisk is up 112%. Crazy SanDisk. And Western Digital's run up 41%. These companies underinvested for years because there was really no need for massive storage. The business was horrible. We didn't have the data. We didn't mine the data. We didn't store the data. So they were absolutely caught flat-footed by the rise of artificial intelligence. They didn't see it coming. The companies that should have been calling up to expand their production, they should have been calling Applied Materials, Lam Research, KLA. They didn't get the call either. They were woefully behind. Now we're in this bizarre, never-before-seen moment where the storage companies just keep raising price over and over and over again. And there's no resistance because these devices are like gasoline in a car. If oil were scarce and gas prices were high, you wouldn't say, I'm not going to use it. You'd have to pay at any price. Why does this matter? Billions of dollars in this country are being allocated to individual stocks every single day. There are many different styles of money management. Some want value, others want solid growth. Still others want companies that can scale, have tremendous franchise value. But the most important style in this country, though, is momentum. These managers want to buy stocks that have accelerating growth, and they want to sell stocks that seem to have slowing growth and are incredibly squeezed in margin. What you're seeing right now is the great transference. For the first time since the creation of the Magnificent Seven back in March of 2023, these stocks have become donors to the market capitalization of these storage companies. To watch the levitation of a Micron or a SanDisk every single morning before the market opens is about what's happening, the transference. When I was on the trading desk, I used to say these stocks are galloping to where they have to go, and it's certainly not right here. It's higher. Even up here, Micron's not expensive on a price series basis, but we don't know how long the memory shortage will last. I think it could last some time. So it could be worth buying even up here, if it's down for a day. And that desire to catch the next hottest stock is driving the money out of the Mag 7 into the memory red hots. Something that Intel took itself out of the running today after announcing a quarter that was less than expected. That's wrong. You have to look out. The demand there is insane. I think we haven't heard the last of this stock, which is up 40% this year. I think CEO Lip Butan has a lot up his sleeve. Intel will be a very hot stock. If you give up on it, I think you're making a big mistake. It's got the mo. Look, it could be worse. If you own a Salesforce, ServiceNow, Adobe, Workday, Atlassian, Simple Team, these are enterprise software companies. You are watching extreme price-to-earnings multiple shrinkage as nervous holders think that the generative AI platforms will make these software outfits obsolete. Like the Magnificent Seven, no enterprise software companies actually missed its estimates. This is all on the come, all psychological. The money's pouring out of enterprise software headed right to storage. The weakness in storage, the weakness in software is happening because the market makes its judgment well ahead of when things actually change. I've come not to trust the software companies myself. I do believe that outfits like Anthropic will allow you to create rival products for a fraction of the cost. I've seen it with my own eyes. No, I'm not going to ban the 7. I own a lot of them from my Travel Trust. I do recognize that right now they're donors. But the bottom line, I think that the money will ultimately flow back to most of the 7, not just Alphabet, which is the only one that's strong. Because these companies just have too many levers, too much money. They're run by people who are too smart to bet against. I'm sticking with the 7. I think the storage plays are going higher. And when they finally peak, you will be handsomely rewarded if you stay with the 7. If history matters, the commodity disk drive players and commodity semiconductor companies will not stay up by year end. Rick in Oklahoma. Rick.
Jim, thanks. What's your opinion now of Palantir Technology?
I like Palantir. I like Palantir. I'm watching, of course, the unbelievable work that our team is doing over in Davos and over and over and over again. What do you hear? Well, Palantir's great. Palantir's great. Palantir's great. I would not leave Palantir. I know it's momentum. It's not going away, but it's the 7 that I like. And the disk drive, the storage, the Seagate, the SanDisk, the Micron, it's their turn. It's their time. They got all the money coming in. But don't overstay your darn welcome. I think money will eventually flow back to the 7 because these companies just have too much going for them. And I wouldn't bet against them for too long. Mad Money tonight. Shares of Proctor and Gamble popped today after reporting earnings. I'm running through the numbers to see if there's more upside in store for this household name. 3M pulled back following earnings, breaking down what to make of the turnaround story, and I think you should buy it. That's a little preview. And the rise in prediction markets has triggered a sell-off in shares of Sportradar. I'm going to sit down with the CEO to see about what all the concern's about. I need you to stay with the 7 and stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This morning, Procter and Gamble reported a seemingly not so hot quarter, yet the stock ultimately rallied 3% today. And now we got to ask ourselves, what the heck is going on? Okay, to understand what happened here, you need to know the setup. This is a stock that has been doing, let's say, poorly over the past year. Procter peaked at $180 and change near the end of 2024, then returned to that high last March before sliding 24%. Finding a floor at $137 and change a couple weeks ago. This thing's been hammered by worries about the state of the consumer, cost pressures, especially from rising tariffs, and huge tariffs for it, and a general aversion to safety stocks while the market was really ripping for most of the year. Now, historically, consumer packaged goods companies, CPGs, are what money managers buy when they're worried about a recession, not when the economy is doing just fine. And the economy is doing just fine. Procter also gave the bears plenty of ammunition when they reported in July, where they gave guidance for the fiscal 2026 year, which ends in June of this year for the first time. That outlook had a very wide range, suggesting management was uncertain about where the business was heading. That's what happens when you have a wide range. They don't really seem to have to control their destiny. The last time they reported in October, they beat the numbers but didn't raise their forecast, signaling that the next quarter, the one they just reported, might struggle. Got to raise the forecast. You want your stock to go higher. Then, at an industry conference on December 2nd, Procter CFO signaled that the quarter had indeed gotten off on a weak start in October and November, primarily because of softness in the United States. That caused still one more leg down for the stock. Two different analysts then cut numbers after meeting with management, which tells you that management wasn't exactly overflowing with optimism. That's the backdrop. Low expectations going to the print. And it's one reason why over the past few months, we, meaning the Charitable Trust, has been buying Procter and Gamble right into the weakness. The stock had fallen so much in 2025 that we started building the position in November, 146 and change, because I felt like many of the problems here would be temporary, especially U.S. weakness that was definitely related to the government shutdown. We even bought a little more 3 weeks ago at $141 and change. We were buying consistently at lower prices. Now, after some continued weakness in the first few trading sessions of this year, the stock did start to heat up a couple weeks ago. All told, Procter & Gamble rallied from 137 and change on Jan 7 to 146 as of last night's close. Lots of money managers seem to be making the same bet that my Charitable Trust had, that P&G can rebound after its lost year, no matter what they reported. That was the setup heading into this morning's earnings report. Even though the stock had bounced off its lows, the expectations were still pretty subdued, which is how you get today's enthusiastic rally after what looked like a not great quarter. And make no mistake, Procter's numbers, they were fairly weak. Revenue came in a little light. Organic sales were flat year over year when Wall Street was expecting 0.5%, a nice uptick. While the beauty and hair care division did well, grooming was flat. Fabric and home care, not great. Meanwhile, baby, feminine, and family care divisions, organic sales dropped 4%. Overall, Procter had a 1% decline in volumes, which was offset by a 1% boost from currency fluctuations and 1% benefit from pricing. I did not like these numbers. Now, despite the top-line disappointments, Procter did do a bit better on the margin front thanks to strong cost controls. The company had a currency-neutral core gross margin of 52.1%. That's slightly beating expectations. On the earnings per share front, thanks to an aggressive buyback, including $2.3 billion in the reported quarter, Procter managed to deliver a 2-cent earnings beat off a $1.86 basis. That's why it looks so good. So let's put it all together. Management signaled last month that we were not going to get great numbers from Procter. But as management also said would be the case in December, Procter reiterated its full-year forecast for 2026, which was positive. It's not lost to me that the very same guidance that was disappointing in July is not one of the best aspects of the quarter that these guys reported this morning. But given the fact that the stock's much lower than it was in June, that's actually not too surprising. So how did Wall Street react? When the numbers came out at 7 a.m., Procter's shares immediately took a header. It dropped 3 points, 3%. I mean, instantly, like it came on, Becky Quick read it, and boom, boom. They were still down slightly when the conference call started at 8:30 a.m., but then quickly it started climbing higher during the call. By the open, the stock was up $2. And then get this, it rallied some more, ending the day up almost $4, or nearly 3%. After today, this stock's at the highest level since late November. It is Katie, bar the door, time to buy Proctor. What exactly did management say on the conference call to turn things around? Well, a lot. First, management explained that a number of the weaker-looking year-over-year numbers were actually influenced by what happened in the year-ago quarter, specifically in the U.S. market. In the year-ago quarter, U.S. sales were elevated thanks to what we call is pantry loading ahead of hurricanes and port strikes. To put a finer point on this, CFO Andre Schulten, who's terrific. I do a lot about his work in how good it is at Proctor in my book. Quote, the balance of the company grew organic sales nearly 3%, with almost all regions outside the U.S. growing or accelerating in the quarter, end quote. In other words, Proctor was up against some very tough comparisons at the time, maybe a little bit obscure what really happened here. Plus, management repeatedly said that this was anticipated to be the softest quarter of their fiscal 2026 and that they expect strong growth in the back half of the fiscal year, which means the first half of 2026. And there was some plenty of legitimately good news here. 7 of the 10 product categories grew or held organic sales for the quarter. Several international markets were called out as particularly strong. France, Spain, Italy, Europe, Mexico, Brazil, Latin America. I mean, wow. Where organic sales growth in Brazil up 8%, 8%. And even China, where organic sales were up 3%. Overall, management had a lot of positive things to say about China, by the way, which is their second largest market, accounting for almost 7% of sales, and it has hurt them over time. Finally, and I think most importantly, I liked this new Proctor management, including the new CEO, Shailesh Jejurikar. And I got to tell you, I was blown away by some of the things that he said about what happened in this very quarter and his full investment in the business. This is not new. Procter and Gamble has said before that they plan to make investments in the business, take out structural costs, bolster their iconic brands. They're investing even when the market's not great, and they're doing so well internationally. Look, it really helps that I think Procter's pulling away from its competitors while putting the company in a position to take market share so they can do even better when the industry bounces back. I think it's terrific that P&G, a huge international company based in Cincinnati, chose Jejurikar, and I think the fact that he's not American could help him in a lot of key relatively undeveloped markets. Look, it's nothing against Cincinnati, but it's okay to have someone who's a person of the world who can really do well in all these markets that I think Procter's not doing well enough in. So let me give you the bottom line here. Even though Procter's quarter was not so hot, this was a stock that most people in Wall Street had given up on. So even mediocre results were enough to send the stock flying today. And look, when a stock rallies on a seemingly disappointing quarter, it's a textbook tell that it's got a lot more room to run. I am glad we bought this one for the charitable trust. I'm going to talk more about how I knew to buy it. I just wish we'd gotten even more for a pullback so that you can add. This one is going higher. Mad Money's back after the break.
Coming up, after years of muddling through, 3M is looking up. Cramer's making his call on whether now is the perfect opportunity to move into the industrial giant. Next.
Let's talk about the nascent turnaround at 3M. 8 years ago, this iconic industrial stock peaked. It was all downhill from there until it finally found its footing in late 2023. Now, look, I used to be a huge fan of this one. But at some point, I gave up on this iconic American company that makes office supplies, household items, industrial adhesives, safety equipment, among many other products, because it had become
the house of pain.
Now, some of that had to do with the Forever Chemicals lawsuits. Remember those? But mostly the company just couldn't seem to get its act together. Bad execution. It's been about 2 years since 3M bottomed, and the stock's more than doubled off its lows, though. This comeback story has been in the works for a long time. In April 2024, 3M spun off its slower-growing healthcare business as Solventum. A couple months later, they brought in Bill Brown, hard-charging fellow, formerly of L3 Harris Technologies, as the new CEO. I have no beef with his predecessor. I think he was simply dealt a terrible hand. But there's no denying that Brown has done a terrific job since he took over. At the same time, 3M announced a major settlement for those forever chemicals, committing to pay $12.5 billion over 13 years to resolve the claims from an American water utility. That's not that bad when you think about it, the present value of that stream. Now, that's a lot of money, I know, but it capped the potential downside from litigation. And at this point, the company doesn't even make forever chemicals anymore. You never know for sure with these matters, but I think the legal risk is very much contained by now. So a couple of years ago, when 3M spun out this Solventum and brought in Bill Brown as CEO, they took some very big steps to put the litigation woes behind them. But what's really gotten the stock going again these past couple of years is good old-fashioned, yes, execution. Management's been so good at being able to deliver the numbers. 3M's organic growth, which is going negative in 2023, turned positive again in 2024, coming in at 1.2%, and then it rose to 2.1% last year. 3M's adjusted operating margin used to be solidly in the mid-20s a decade ago, then fell around 20% from 2021 to 2023. But that, too, has been recovering over the past 2 years, making it back to 23% last year. Their earnings per share, it bottomed at $7.30 in 2024, then rose 10% to $8.06 last year. Now, ever since Bill Brown was named CEO a little less than 2 years ago, the stock has more than doubled. And while I said some good things about 3M in April of 2024, and I've been generally positive about it when asked the light round. I got to admit that I have never really stuck my neck out for 3M. That was wrong. I've mostly been watching this incredible move from the sideline, just itching for a better chance to buy the stock. And that's why tonight I'm talking about it, because when the company reported on Tuesday morning, I think the market got it wrong. First of all, the stock was just hammered. It's down over 4% this week, even after a nice gain today, and down 8% from its December highs. Opportunity. A week ago, this was a $171 stock, and now it's at $160 and change. I like that. Why? Well, for starters, I think Wall Street totally overreacted to that latest quarter. 3M's organic revenue growth came in at 2.2%, a little worse than expected, but still showing some continued progress. Their sales were in line. Their operating margin was a little light, yet they still delivered a 3-cent earnings beat off a $1.83 basis. That's 9% earnings growth. I'll take it. So the fourth quarter results were fine. How about the guidance? Another thing people were worried about. I saw a bunch of headlines calling the forecast disappointing. But wait a second. For the full year, 3M guided for 3% organic sales growth and 4% total sales growth, both nicely higher than expected. Their earnings and operating cash flow forecasts were in line. Only their operating margin guidance came in a little light. They're talking about 24.1 to 24.2. Okay, Wall Street was looking for 24.4. Overall, I think you could call it a mixed bag. But you know what? I think that's too negative in itself. A little less than a year ago, 3M held an investor day where they rolled out some medium-term financial targets for 2025 through 2027. And when management announced its full-year forecast for 2026 this week, the numbers show that 3M is mostly ahead of schedule on its way to those medium-term targets. Nothing wrong with that. So why then did the stock get obliterated? Okay, some of it's because 3M's calling for 6 to 7% earnings growth this year when some investors were hoping for something closer to 10%. That wasn't in the actual sell-side earnings estimates, but 3M did say they were expecting high single-digit earnings growth by 2027. My view. Look, I don't mind a conservative forecast that can be beaten, and I do think it will be beaten, because 3M's now quietly beaten the earnings estimates for 12 straight quarters, including all 6 quarters where Brown has been leading the company. So it wouldn't surprise me if they can put up 9% earnings growth this year when all is said and done. A year ago, 3M guided for earnings of $7.60 to $7.90 per share in 2025, and they ended up delivering $8.06 per share. As for the disappointing operating margin, well, let's dig into this. It only came to light in a little light. This is the forecast we're talking about. And that comes down to higher investments in the business, costs from shutting down the forever chemicals, and, of course, tariffs, which they can't control. Come on. I don't mind investments or the hit from forever chemicals, and we know the tariffs are beyond 3M's control. Finally, there's been a lot of criticism of the quarter centered on 3M's consumer business, which did have a genuine shortfall, the only one. But the consumer business is the smallest part of the pie here, accounting for just 20% of 3M's sales last year. So I'm not sure why everyone's laser focused on it. The strength in 3M's safety, electronics, and industrial end markets was more than enough to offset the consumer weakness, along with some softness in roofing and autos. And by the way, and this is what really bothered me about this whole thing, I've read the whole conference call twice. If you listen to what management said about the consumer unit, you would feel a lot better than what the headlines indicated. On the conference call, Brown explained that the shortfall here was driven by weaker consumer sentiment, sluggish retail traffic in the U.S. Okay, we get that. But how about this? He also said that after a tougher start to the quarter, the consumer business had a very, very good December. And though it's early, January is looking okay. Overall, management expects 3M consumer business to return to growth this year. Why sell it on that? Putting it all together, I see a company that remains very much on track. I know this is a contrary view from the street. The turnaround is real. People feel it's not anymore. Best of all, Brown talked about how 3M has returned to a culture of innovation after years of playing defense. Last year, this used to be a product introduction company. Get this. Last year, 3M launched 284 new products. That's a 68% increase from 2024. This year, they're expected to launch 350 new products, new lifeblood. Sales from products launched in the last 5 years were up 23% in 2025. And as 3M exited the fourth quarter, sales from new products were up 44%. That reminds me of 3M of old. People are selling it. Come on. Here's the bottom line. After this harsh pullback, I think you're getting a chance to buy into a great turnaround story for the first time. And at a discount. First time I've seen. 3M looks very cheap to me. Selling for just under 19 times the midpoint of their full-year earnings forecast. A forecast I expect them to beat. You have my blessing to buy it right here, right now, tomorrow morning. I want to go to Jim in Florida. Jim.
Jimmy Chill, a big, sunny, warm Naples, Florida. Booyah to you.
Well, making fun of me? I'm staying at a hotel down the block because it might snow on Tuesday. What's happening?
I'm calling about a stock that I bought years ago, 2011. They merged with another company in 2015. I waited to buy it back, and now Warren Buffett is getting rid of his 28% share in the company. What's your opinion of Kraft Heinz?
Well, okay, so we know that it's not Warren. It's the new fellow that took it over. And he doesn't, I don't blame him. He doesn't want to have the position on his sheets. I do like Steve Kale-Lane. He's the new CEO. He came from Kellogg. But Ben Stoddard and I kicked this one around, and we decided we just couldn't get behind it. There's not enough good happening in the food business. I'm a seller, not a buyer. All right, let's go to Garrett in New York. Garrett.
Hey, Jim, I own almost 300 shares of Target. What do you think?
I think that you got to hold on to Target. Got a new CEO. Target seems to find itself in all sorts of trouble all the time. But for the first time in a long time, this stock is bouncing off its low with a 4% yield. I am going to bless you owning Target. Put someone here, and you have 300. Maybe even buy another 100 if the stock gets to 100. Let's have the new CEO on. I really want to speak to him because I've been a big Target fan for a very long time. All right, the stores. Look, I think you are getting a chance that I don't ever pound the table. I rarely pound the table like this. To buy the stock of 3M here, the turnaround is real. The stock looks very cheap to me, and I've missed it for a long time, and now I'm finally getting in. Much more Mad Money ahead, including my sit down with Sportradar. This picks and shovels play in the sports betting space fallen out of favor in recent months. I'm getting this story straight from the company's top brass. Then I might not have a PhD in psychology, but I do know how big of a role psychology plays when it comes to earnings season. And tonight I'll reveal how you can separate facts from feelings to stay ahead of the pack. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All right, what the heck happened to the stock of Sportradar? It's a key partner for the sports betting industry that we like very much. These guys provide match data, odds, and advertising tools. They're basically a picks and shovels play on sports betting thanks to their data rights partnership with the NBA, MLB, and NHL, as well as many international sports leagues. With online gambling taking the country by storm, you'd think that business would be great, right? But Sportradar stock is now down more than 40% from its high last August. Now, some of that might be due to the prediction market moving into sports betting and taking share. I don't know. Some of it, maybe they disappointed the last time they reported. We got to find out what's going on here. Could this be a terrific buying opportunity as we head into the Winter Olympics, where there's going to be a lot of betting? World Cup right around the corner? Let's check in with Carson Curl. He's the founder and CEO of Sportradar to find out. Mr. Curl, welcome back to Mad Money.
Hi, Jim. Thanks for having me back.
Well,
thank you to be in the show.
Thank you. I'm glad you're here. The stock has taken a hit, but I don't really necessarily see what has caused that. I know that some people feel there's been a slowdown in gambling, but I'm not sure about that either. I know it seems like the stocks have gotten out of favor, not the companies.
Well, Jim, you know I'm in the quiet period, but what I can tell you is we feel pretty strong about the business. And what we see is investors don't like uncertainty. There is an uncertainty with prediction markets, as you know. And for us, it's a fantastic upside opportunity, more TAM, which we can address, California, Texas, Florida, addressable for betting. And they all need our data, and they all need our algorithms. So this is something which we see very, very positive. And I think on the mid to long term, this will shake out, and we will focus on deliver like we did it all the time.
All right, so let's talk about California, Florida, and Texas. These are states that have not voted to legalize gambling, but when it comes to the prediction markets, they're not illegal. So explain what you can do with the prediction markets, or maybe just with real-time data. I don't know what you guys have been able to accomplish, but it looks like you can just bet on games with prediction markets, and that you would be able to help on that.
Good. There are two segments. One is the pure data, the content, which we have together with our partners. And you mentioned before the picks and shuffles, which I like very much. So we're sitting on this. We have the contracts, and we are the partner of 3 of the big 4 leagues. So that is one piece. The other piece is the market makers. The market makers, as you know, they need that detailed information. They need the tendencies. They need the risk profiles and all those things. So that's something we have the perfect products for this. The only thing, Jim, which stops us at the moment is we are waiting for our partners from the sports side. And I'm concerned about sport. I'm concerned about the rail guards here. And we're going to need to protect the integrity of the match. That's the first thing which we need to do. No sports betting without the protection on this. Yeah. So the leagues are negotiating this. The leagues have their AGO agreements, and I'm totally confident that in the next couple of weeks, you see that they are closing here some deals. In that moment, when we have the rail guards, we deliver our products in there. So for us, it's a total upside opportunity. Bigger TAM. You mentioned California, Texas, and Florida. I think it's more than 50% of the US GDPR, which comes now all to play. So much earlier than we thought on one or the other way. But it's for us a fantastic opportunity.
Well, to me, what I care about are events, and events to gamble on, because it happens to be much more accepted, obviously, in the country. And I think that some of what caused your stock to suffer is people feel it's kind of gotten out of style. I think that we're going to have a very high-profile event in the Winter Olympics, and a lot of people are going to use this time, for the first time, to be able to make bets on the Winter Olympics. What does it look like? What is the chatter about it?
Last time, Winter Olympics, we saw most of the bets coming on alpine skiing. Downhill race is the most prominent one. I bet with you, Jim, this time it will be hockey, because NHL is since 11 years the first time there. All the stars are there. I'm super excited about this. It's around the corner. I will be there. And this is something where I think we see new landmarks here from a betting perspective. And mainly hockey is something where we are pretty optimistic.
Okay, how about World Cup?
World Cup is the biggest betting event in the world. Last World Cup was 50 billion. Oh. Now we have nearly double the teams. We have 48 teams and 12 groups. We have more than 100 matches in the World Cup. That is unprecedented. So that will have an enormous volume. And if I look now to technology and compare it to 4 years ago, we have 200 live markets. We have 200 pre-match markets. We have the player props. We have the micro markets additionally. The volume will easily exceed the last benchmarks. And the fun will be great. And the special thing here is, if you look now to the Americas, South America is not only there with the giants, with Mexico, with Brazil, with Argentina. They have Ecuador there. They have Colombia there. Haiti is going there. So the whole world is looking on this. But the development opportunity for soccer in the US is enormous with this pull. And we see a lot of countries from the continent playing there. So I'm very excited. And I will watch a couple of those matches, and I hope you too.
Now, the last thing I care about is, do you think that Wall Street will understand that this really is a terrific opportunity? I read the research, and I think that people are a little defensive. Now, look, they can be a little defensive, frankly, because of the gambling scandals, but I know that would really help things is if people just got behind it and said this stock has gotten too cheap. I don't know. I know you're in the quiet period, but is it your sense that that people understand that these two events could be huge for you?
Yeah, that's what I think they will understand when we show the numbers. So looking purely from an event perspective, it's a unique constellation, Olympics and the World Cup in 1 year. Of course, that's driving revenue for our clients. And when our clients are doing well, we are doing well.
I think that's,
so I'm totally confident.
All right, that's where I'm going to leave it because I don't think the stock belongs where it is, but we'll have to see. And I want to thank Carsten Kurls, the CEO of Sportradar Group. Good to see you, sir.
Thank you.
Mad Money's back after the break. And then the lightning round is over. Are you ready? Ski Dad. Time for the lightning round. Start with Ron in Florida. Ron.
Jim, I'd like to get your opinion on Steel Dynamics. I've owned it for a couple of years. It's been a great performer.
It's an excellent company. I like Steel Dynamics and I like Nucor. Those are the two. Wow, what a terrific buy. This is America doing well and the tariffs working. Let's go to Ray in Virginia. Ray.
Jim, in November, I bought a cashmere sweater. Hey, my stock looks like it's on an upswing. What's your take on RPRX?
Royalty just keeps going higher. I love the step function. I love that whole business where they help fund bio and they get the returns. It's a terrific company. I remember when GA bought it public, and I liked it then. I liked it now. Let's go to Sam in Pennsylvania. Sam.
Jim, I got an interesting one for you. I've been looking at the optical electronics market, specifically looking at connectivity solutions given the AI build-out. So I came across Credo, and that led me to find its competitor, Coherent. So I was curious what you thought about Coherent, given its recent run-up.
Yeah, Coherent's so good. Now, the stock has been just a banshee, but I got to tell you, the technology's really good. It's a winner. I would use any dip to buy more stock. Tom in Iowa. Tom.
Hey, Jim. Love your show
buddy.
and all the work that you do. Big shout out to my two young investors, Kendra and Claire. Jim, I want to get your thoughts on New Era Energy.
New Era Energy, I don't know. I got to tell you, something crazy is going on there. Let me do some work on it and come back to you. I don't want to cuff it. Let's go to Bree in California. Bree.
Hey, Jim. So I bought shares of Lucid Group back in 2021, and I am deep in the red. So with the company
take the loss. I mean, look, Rivian is at 16. If you like those new, if you like that, Rivian is better. I don't, but that's the one you want to be in. And by the way, can I just say Mary Barr's unbelievable, gets no credit whatsoever. That seems wrong to me. Mike in Michigan. Mike.
Hey,
Mike.
Hey, I'm making it quick for you, man. I'm calling about. I got a stock. I was down 60%. And now I'm only down 5%. I'm worried about California regulations. Ticker symbol SOC, Stable Offshore.
Not a great company. Not a great oil services. Not a great oil company. We're gonna have to stay away from that. We're gonna do a little ka-ching. Get out of that, boy. Jim in New Jersey. Jim.
Yeah. Hey, Jimbo. How you doing, my friend?
I'm good, Chief. I'm great. What's up with you?
All right. Looks like we're closing out the show together. So I got to ask you a couple questions. Okay.
Go ahead. I'm ready.
Maybe a little more than a year ago, you talked about an IPO, and of course, it's an energy company. Mm-hmm. And this company's on the equivalent of Chenery now. Its infrastructure's expanded. You did warn about the lawsuits that they had, and it seems like they got through them, and they did quite well, and they still abided by the contracts on those companies. So I'm going long with this company because I think they're going to be big. I'm going with VG, bud.
Venture Global, no. Venture Global, we do not like it. We did a really good piece about it the other day. We just think that they just didn't deliver, and we don't think they're going to deliver at all. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's taking 3 recent examples to show you how psychology can help you get into or get out of stocks at the right time to maximize your profits. Next.
How did we know to buy the stock of Proctor and Gamble for the charitable trust ahead of a weak and seemingly disappointing quarter? How did we know to pass on GE Aerospace before a terrific quarter and instead throw our lot with the long-time ne'er-do-well Boeing? How did we catch a nearly 3% gain in Procter & Gamble one session and 0.5% gain in Boeing, but dodging a nasty 7.4% loss in GE? Let me explain, because I want to teach you how to make money during earnings season. See, you start with a proposition. You're looking for a stock, a major stock that's down near the bottom of the range, basically a fundamentally fabulous company that's fallen on hard times momentarily. You select it because you want to start with a good cost basis, meaning you want to buy it on the cheap. Why start ahead of the quarter then? Because of psychology. We picked the stock of Procter & Gamble for the trust because it has a long history of innovation, improvement, and execution. We knew it has solid dividend, one of the best dividends in the entire market, serve as a trampoline if the stock goes low enough. Before the quarter's release, Procter had been adamant that they were going to miss the numbers. It was very well telegraphed. The disappointment occurred beforehand, the selling to lose behind it, so when we saw the numbers today, it didn't matter. Best of all, Procter has a new CEO. This would be his inaugural quarter, so he didn't own the previous CEO's mistakes. Fresh start for the CEO, Shailesh Jejurikar. Nothing wrong with Cincinnati, save the Bengals, but this is an international company. It's where the growth is. It's about time that someone who was foreign-born became the CEO of Procter. What did we know about Boeing? Well, it hasn't reported yet. We bought it aggressively and all the way down endlessly because management told us that they couldn't shoot straight and the term was delayed. But it did add that the cash flow would be higher than expected. We told Investing Club members to buy and buy and buy, down 50, down 60, down 70, because we knew that the cash flow was the key metric to watch here and the rest is just noise. You needed to follow Boeing for 30 years, as I have, to understand this. As my dad, who served in the Pacific, reminded me, for his first year of the war, all he saw were zeros and death. But then he saw silver planes. That was the Boeing B-29, and he knew the war was over. See, you can't defeat Boeing. How about GE Aerospace? It's the best of the best. Self-improvement here is extraordinary. CEO Larry Culp is one of a kind, the savior of the old GE, architect of the most successful breakup of all time. 2 years ago, the stock was at 62. Came in hot, 318 today. Just a monster. So what happens? Procter's quarter was weak as expected with misses on several key lines. GE Aerospace, nothing but net, just fantastic. Every line, including ones that have been a tad disappointing previously. Gross margin improvement, remarkable. GE stock opens down a tad, then rallies to 310 before wilting and finishing down more than 7%, 295. Nothing wrong. But an A student who gets more A's, an A student gets more, that doesn't get any praise. And in fact, gets criticized for those who want to see A+. Procter & Gamble, we see the headlines. Stock plummets early morning from 146 to 142. That's exactly right. You want the traders out of it. The scared shareholder base disappear. And then the new CEO speaks, as we mentioned earlier. He starts talking. He talks about the nation turn in China. He talks about the green shoots in Latin America. Lots of international growth opportunities. He makes it clear that he's unhappy with the company's performance. And more important, he made it clear that such underperformance will not be tolerated. He hit the ground running. He says, quote, "We are already seeing strong results in parts of the business," end quote. And then he mentions some business lines that have started doing well. P&G closes at $149.93, up a whopping 7 points. 7 points from where it started. You had to buy this one before the quarter. You see, it's all psychological. People had written off Procter and Boeing, which made a new high today. They love GE, got clobbered. When a stock gets too hated or too loved, it's often due for a trajectory change. And this time, the earnings provided the catalyst. I'd like to say, as always, bull market summer. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer, and I will see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC or its parent company or affiliates and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.